Welcome to another edition of Taking Stock for the week ending the 27th of June, 2025. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our equities analyst, Charlie Song, to stream into all things share market. Welcome, Charlie. How are you?
Thanks, Ken. Great to be here.
Yeah, great to have you on board, Charlie. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Well, Charlie, I can't believe it's close to the end of financial year, and it looks like will be another positive one for share markets, especially for that financial year, with markets now close to around 13% returning that much over the year. But this week it's been quite interesting. It's been relatively upbeat. We had US equities; they continue to hover near record highs, with investors balancing this optimism around moderating inflation and the potential ceasefire between Iran and also Israel. And this has led to some profit taking across the energy space, especially across our star stock, Woodside Petroleum.
Yeah, that's right. And closer to home, the ASX has edged higher this week, led by gains in interest rate sensitive sectors. The big story locally was the May inflation print, where headline annual CPI came in at just 2.4%, well below expectations. That's reignited speculation that the RBA may cut rates in July and August, and has provided a welcome tailwind for consumer-facing stocks.
Yeah, quite interesting there, and hopefully that would support markets. But one risk that's flown under the radar is the looming US tariff deadline, and that's on the 9th of July. With just 2 weeks to go, financial markets appear quite complacent, pricing in the assumption that President Trump will extend the tariff pause again. Although the UK and China have managed to secure an extended truce with the White House, if no new trade deals are struck, there could be more volatility across the markets.
Yeah, and overnight we saw share markets in the US trading at all-time highs.
Mm.
We'd like to remind investors of the importance of portfolio risk management. And that's ensuring you are diversified across high-quality businesses, reducing your exposures to financially weak companies, and taking profits on stocks that have rallied too hard and too fast. That way, you can accumulate some cash to take advantage of potential volatility down the track, especially over the upcoming reporting season.
Yeah, there's going to be some beats and misses over that reporting season, Charlie. But let's now turn our attention to some star stock highlights this week. Let's start with borderline star growth stock, Treasury Wine Estates. The company reaffirmed their financial year 25 earnings target of around 770 million. So that's roughly a 17% lift on last year and slightly ahead of market expectations. Quite impressive considering the patchy demand in the US.
Yeah, and this announcement should support its forecast return on equity of around 10%. Penfolds continues to shine in Asia, especially after its re-entry into China. Meanwhile, the acquisition of Dow, which is a premium Californian wine label, has helped support the Americas division. That said, broader softness in the more value wine segment, particularly brands like 19 Crimes, is still a challenge.
Yeah, consumers aren't spending on those value type wines, but this has led to negative share price sentiment on the stock. In addition, you've had the upcoming CEO transition from Tim Ford to Sam Fisher. That's expected in October. But that said, Treasury is guiding for further growth in financial year 26, and that's helped by a sharper focus on those luxury wines under its new Treasury collective structure. You've got higher margin products like Penfolds. They are expected to boost the return on equity and profit margins, which had come under pressure during the US slowdown.
Yeah, that's right. But despite the negative sentiment, Treasury Wines has announced an on-market buyback of up to 5% of issued capital. That management have cited strong free cash flow and balance sheet flexibility as the reasons for pursuing this buyback. This suggests management do view the decline in share price as an opportunity.
Yeah, definitely. And also reinforces the strong financial health of the business. But moving from wines to mines, let's focus now on iron ore producer Rio Tinto. The company has committed around 800 US million to the Hope Downs 2 iron ore project in Western Australia, and that's in partnership with Hancock Prospecting. That's part of a much broader capex plan. Rio expects to invest over 13 billion in US dollars in iron ore expansion through 2027.
Yeah, the goal is to maintain long-term production capacity in the Pilbara amid rising costs and grade declines at older mines. But investors are rightly asking, is this the best use of capital? Rio's share price has underperformed in recent months, and concerns are building around the returns on these heavy investments.
Yeah, that underperformance has been tied also to, the weakening iron ore price. But part of the issue is that Rio has negative growth outlooks in the near term, and their return on invested capital is already under pressure. That's expected to decline to around 27%, although quite high still. To justify this spend, though, Rio does need to be quite efficient with its project execution and also a supportive commodity price environment as well.
And with so much capital committed, there's a risk to the dividend. But for now, with the gross dividend yield of 8%, this presents sufficient margin to compensate income investors for the uncertainty around the decline in free cash flow, especially in FY26 as capital expenditure ramps up.
Now, for Under the Microscope, this week we take a close look at cloud accounting provider and borderline star growth stock Xero, which just announced a massive deal buying US payments company Melio for almost 4 billion Australian dollars. That's a big bet, Charlie, considering it's around the 13% of Xero's total value.
Yeah, it's quite large and it's all about scale and integration. Xero has long struggled to gain meaningful traction in the US market. This acquisition is designed to fast track its US expansion by embedding Melio's payments capabilities and infrastructure directly into Xero's platform. That plays into their broader 3x3 strategy to offer a full suite of accounting, payroll, and payments in each of their three major regions: Australia, New Zealand, the UK, and North America.
Yeah, very interesting, Charlie. But Xero already has some payment functionality, doesn't it?
Yes, it does, but not at this scale or level of complexity. Previously, Xero relied on external integrations with third-party platforms. They've had a partnership with Bill.com, which has gone live recently, and Bill.com is a competitor to Melio. But by owning Melio outright, they now gain end-to-end control of bill payments and accounts receivable, whilst also acquiring a very significant and relevant customer database. By owning Melio outright, that also improves monetization and customer stickiness. That said, integrating a fast-growing but loss-making startup is no small task.
Yeah, that's an interesting point you make there, Charlie, especially when the US market is already dominated by players like Intuit's QuickBooks, which reportedly holds over 80% share in the small business accounting segment. How does Melio fit into that competitive landscape?
While Miller isn't an accounting software rival, it's a payments platform that integrates with players like QuickBooks and Xero, but it has built strong distribution channels through partnerships with Shopify, Capital One, and Fiserv. Xero's bet is that by embedding Melio's functionality, it can raise its profile, triple its US revenue, and improve average revenue per user significantly over time, leading to a rise in its return on equity over the long term.
Yeah, sounds quite positive there, Charlie. But let's talk about how this deal is being funded. It's pretty complex, and could potentially derail its strong financial health?
Yeah, that's a major risk. Xero is funding the deal through a mix of equity, debt, and cash. Almost $2 billion is being raised from shareholders, adding about 7% more shares, and another $600 million will come from cash reserves and new debt. As a result, the company's strong financial health may weaken slightly. Xero is going from a net cash position to a net debt to earnings ratio of around 2.3 times, which is not excessive, but that is more debt than they had before.
Okay, you also mentioned, Charlie, the increase in the number of shares. And so let's focus on that dilution. The share price reacted negatively because investors seem to be concerned about the near-term impact on margins and their return on equity.
Yeah, and that concern is valid. Melio is still loss-making, and it's only got a gross margin of 19% on paper, compared to Xero's 89% gross margin. This deal is expected to be dilutive to its profit margins and free cash flow until at least FY28. So therefore, ROE is forecast to decline in the near term, and it's unlikely to return to current levels until that FY28 mark. Xero will need to significantly scale revenue and cross-sell Melio in the meantime to meet its ROE and future profitability targets and justify that acquisition cost.
Yeah, so the upside is more long term and the risks are very real in the short term, Charlie. You've got integration, execution, financial health. There's a lot there to juggle.
Exactly. And you're dealing with valuation risk. Right now, the stock trades on a forward price earnings ratio of about 90 times. That's a very high valuation for a business facing gross short-term profit drag and execution risk.
Yeah, a lot to think about there, Charlie. From our side, we're placing Xero under review while the strategic rationale makes sense. And this could accelerate their US ambitions, the short term drag on profitability. You've got the potential for weaker financial health and elevated valuation are key risks we are currently evaluating at this time. As the end of financial year approaches, a few of our members may be wondering what is the better metric to use when evaluating the performance of their portfolios? Is it the time-weighted return or the dollar-weighted return?
In the portfolio manager, you will see two types of returns on the top right corner. Having two returns can be confusing, but to clarify, the time-weighted return measures the performance of your portfolio regardless of when you added or withdrew money. It's often used to compare how well an investment strategy or fund manager has done over time relative to a benchmark because it removes the impact of cash flows, which can differ for each portfolio.
Very interesting, Charlie. But meanwhile, the dollar weighted return tells you the actual return. It takes into account the timing and also the size of your contributions or withdrawals. For example, if you invested heavily just before a market correction, then this correction will weigh strongly on your portfolio performance.
If you're comparing investment strategies or how your portfolio is performing versus the index, use the time weighted return.
Yeah, but if you're reviewing your portfolio alone, especially around tax time, the dollar weighted return is more useful. It reflects how your timing and cash allocation decisions affects your performance, not just how the market has moved. But that's all we have time for today. If you have any questions or would like more insights into our episode, join us for our Lincoln Live this coming Monday. But great to have you on board, Charlie, once more.
Yeah. And if you know someone who could benefit from Stock Doctor, now's a great time to refer them, as our end of financial year offer is currently available.
Yeah, good point there, Charlie. As always, we are incredibly grateful for the ongoing support from our members. In the meantime, take care and have a happy, healthy, and prosperous week ahead.